The incontestability clause is a mandatory provision for the national life insurance exam that serves as a statute of limitations on the insurer's right to challenge the validity of a life insurance contract. For the national exam, you must understand that the standard time frame for this clause is 2 years. This means that after a policy has been in force for 2 years during the lifetime of the insured, the insurance company is prohibited from contesting any statements made on the original application. Even if the company discovers that the applicant committed material misrepresentation or outright fraud, the policy remains valid and the death benefit must be paid to the beneficiary. On your exam, you will likely encounter a scenario where an individual hides a terminal illness or a dangerous hobby like skydiving when they apply for coverage. If that person survives for 2 years and 1 day after the policy is issued, the insurer is legally bound to honor the contract. This is a common point of confusion because in most other areas of contract law, fraud can void a contract at any time. However, in life insurance, the incontestability clause is designed to provide security for beneficiaries and to force the insurance company to do its due diligence and underwriting at the time of application, rather than waiting until the insured has passed away and can no longer defend themselves. Materiality is a concept you will see often on the exam, and it refers to information that would have caused the insurer to decline the application or charge a significantly higher premium had they known the truth. If a lie is immaterial, such as a minor misspelling of a street address, it generally would not be grounds for a contest even within the first 2 years. But the incontestability clause is unique because it eventually protects even the material lies. You should also be aware of how the clause interacts with the death of the insured. If the insured passes away 18 months into the policy, the insurer has the right to contest the claim indefinitely because the policy did not stay in force for 2 years during the insured's lifetime. This stops the clock and allows the company to perform a thorough investigation into any suspected fraud or misrepresentation that occurred during the application process. When you are studying materiality, remember that a fact is considered material if it would have caused the insurer to not issue the policy at all or to issue it only at a higher premium. During the first 2 years, which is known as the contestable period, the burden of proof is on the insurer to show that information was withheld or falsified, and that this information was material to the risk. If the insured dies within this 2-year window, the company has the right to investigate and potentially deny the claim if they find significant discrepancies. A major trap on the exam involves the misstatement of age or gender. You must remember that the incontestability clause does not cover these 2 specific items. If an insurer finds out 10 years later that an insured lied about being younger to get a lower rate, they cannot void the policy, but they will adjust the death benefit to what the premiums paid would have purchased at the correct age. Do not let the exam trick you into thinking the policy becomes void for an age lie after 2 years. Another critical exam point involves policy reinstatement. When a policyholder lets their coverage lapse and then reinstates it, a new contestability period usually begins. However, this new 2-year period typically only applies to the information provided on the reinstatement application and does not reopen the contestability of the original application. To keep this straight in your head, you can use the phrase 2 years to find the lie or the claim they must supply. This reminds you that the insurer has a limited window to act. Aside from these extreme cases, the 2-year mark is your definitive cutoff. Remember that this clause does not apply to the non-payment of premiums, as the company can always cancel a policy if the owner stops paying. Focus your study on the timeline, the shift in the burden of proof, and the specific exclusion of age and gender misstatements from this provision.